The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to this Thursday edition of Squawk Box with Carolyn Roth and myself, Steve Sedgwick. And these are your headlines. Well, my first headline says in the driving seat, but I guess the point is one day there won't be a driving seat for Tesla. That's why the shares jumped in extended trade after faring better than expected in their third quarter earnings, as the CEO Elon Musk sounds a bullish note, as he always does, on sales.
I do want to give some rough estimate, which is I think 20 to 30% vehicle growth next year. Notwithstanding negative external events.
And the trade continues. US Treasury yields pick up. The dollar rallies. The yields are hitting a 3-month high as concerns over fiscal spending and the upcoming election take hold. But the IMF's first deputy MD, Gita Gopinath, tells CNBC the macro environment is heading in the right direction.
We do see inflation returning back to target by the middle of next year for the US, for Europe, and for many other countries.
Chip giant SK Hynix posting a record quarterly profit and downplaying concerns over an AI supply glut, driving the stock higher in Seoul. French luxury giant Kering halving its full-year operating profit forecast after sales at its flagship Gucci brand go from bad to worse.
Good morning, Carolyn. How are you?
How are you? I haven't seen you in ages.
What, like since yesterday?
Well, since yesterday, but that's a long time, no?
It is, I know. I think you've got it in your contract. You don't have to work with me that often, but there you go, never mind. Look, here's a fascinating thing, and I'll say this in mind, the fact that he's sitting next to us as well, and we haven't even introduced him yet. Hello, he. Good morning, Arjun. How are you, buddy?
Steve. I'm
I
good.
still need to know more about your wonderful Tokyo trip. It sounds fantastic as well. Look, the reason why I've kind of almost brought you in at this moment is because I know we've got a CEO waiting in the wings, so I've got to be a bit careful here. It's because there could not be a greater comparison between Tesla and the traditional OEMs. Traditional OEMs are beaten up aggressively, unless you're Ferrari, in which case you're a different basis. There couldn't be a greater difference in pricing value between the Renault, which is just reporting, and I'm going to get to this in a few moments' time, and Tesla yesterday. Tesla trades at 80 times forward. It is not a car company for all intents and purposes. We can discuss this again with Arjun in a moment. Renault trades at 3.5 times forward.
And you could argue that's a screaming buy, but there's always a reason it's that cheap, right?
I have been looking at this sector for 20 years. It is underperformed and has been the biggest value trap of any sector I've looked at, genuinely. Anyway, so there you go. So I'll just do some Renault figures as well, and then we'll get into what I'm supposed to be doing. Fourth quarter, a big one. Third quarter 2024 revenue up 5% at constant exchange rates. Expect product mix significantly higher in fourth quarter. I don't know what that means. Maybe they're talking about the BEV vehicles as well. Constructing budget assumptions to be compliant with European CO2 standards by 2025, but all manufacturers will have problems if EVs remain at current levels. There you go. There's another EV warning. They all invested. Do you remember the Carlos Ghosn years? That was before he smuggled himself out of Japan to Lebanon. But the Carlos Ghosn years, they were one of the first to come up with EV vehicles as well. So Renault been in the game a long, long time. New launches represented 18% of invoices versus 5% on average in the first half. As I say, revenue, third quarter automotive, 9.35, slightly above expectation. Let's move on to Tesla, actually, because that's where I need to go. Tesla shares jumped in extended trade after the car maker topped analyst estimates for its third quarter earnings and gave an upbeat guidance for deliveries this year and next. Revenue rose 8% in the quarter, narrowly missing expectations, whilst net income jumped 17% to $2.2 billion. Elon Musk said he expected higher growth next year, mostly due to lower cost offerings, but not a Model 2, and the advent, yes, you guessed it, of autonomous vehicles.
To take a bit of risk here, I do want to give some rough estimate, which is I think 20 to 30% vehicle growth next year. Notwithstanding negative external events, like if there's some force majeure events, like some big war breaks out or interest rates go sky high or something like that.
I don't think we've ever seen a human being in business history like Elon Musk. There's been meteoric people, there have been extraordinary entrepreneurs. I don't think anyone I've known has combined so many different and contrary features as well. But one thing about Elon Musk is his extraordinary, and no one can deny it, his extraordinary optimism when it comes to his project. I've never seen a CEO who comes up with such outlandish delivery expectations, misses, and the shares still trade at 80 times, who comes up with so many protestations about what the technology can or can't do. Getting to Mars is a great case in point. The market has taken him on his word yet again about the forward outlook and about the prospects for robo-taxis. How many times has he got a promise, not quite get there, but the market still loves the rhetoric?
Yeah, this is the point. But I think it's more, I would say this quarter wasn't so much about the future. It was more just a sigh of relief from investors, I think, more than anything. There were extremely low expectations coming into this quarter. There was confusion after the Cybercab event about what exactly it is.
It wasn't confusion.
When it's
there was a lack of... You go under the hood.
Lack of detail.
The thing is that you go under the hood and say, oh, look at that beautiful V6 or V8. I know nothing about cars, by the way. You do, because you're German. But you go under the hood at the robo-taxi event, there was nothing there.
Yeah, exactly. And all the market wanted to see in this quarter was literally, can you arrest those declining margins? And that's what Tesla managed to do. You look at those gross margins jump in, the profitability was much better. It was just a sigh of relief from investors. Now, you look forward, of course, into 2025, Tesla promising this low-cost car, promising growth of vehicle sales somewhere in the region of 20-30%. You have to take that with a pinch of salt, given the track record of Elon Musk over the past and some of the promises he's made in the outlook.
I mean, he promises so much. What he's doing, essentially, is dangling this carrot in front of investors' eyes. They really have to believe that story. And we've seen cracks starting to appear in that full belief into the Elon Musk story. I got to ask you a political question here, because we're obviously less than 2 weeks away from the U.S. election. His affiliation with Trump, does it help him? Does it hurt the business? Does it even matter in this context? We know that Trump is not a friend of the whole EV industry, but because of the bromance between the two, will he be softer on regulation?
Yeah, there seems to be, we've had this debate over whether Elon Musk's sort of personal views on stuff is impacting the Tesla business, impacting his brand. It feels like there was a point when it was, and that seems to have gone away, even as sort of his rhetoric has ramped up, his closeness to Donald Trump has ramped up as well. So it feels for now the Tesla business does have some sort of bubble around it. It's still, in many respects, a cool brand. It's still an EV brand that many people want as well, and particularly in markets like China, though that is sort of partly eroding with some of the competition. So when it comes to sort of the Tesla brand, it still has some aura there, I think, as an EV player. The key is going to be what this next new lower cost model looks like. Is it going to be very similar to the Model 3? Is it just going to be a stripped down version of the Model 3? Is it going to be something new and flashy? And the issue Tesla has right now is the stale product portfolio right now, because it hasn't really brought out a new mass market model in a long time.
And everyone was looking for some of the commentary here. Obviously, he said that the upcoming affordable EV will cost less than $30,000 with incentives. And I think that's the crux of the matter, right? There's so many incentives that the company is rolling out, and that's hitting margins. So you're not really going to make money on that lower cost model, are you?
No, I mean, that's gonna be. Look, one of the things Tesla's done very well is the manufacturing side of the equation. They've managed to figure out that as well, and figure out how that's going to play into the ultimate margins. But one of the big keys here, and this is something the bulls talk about, is autonomy. The future of Tesla is around autonomy, and if they figure that out, that's really what's going to support their share price. So Daniel Ives, analyst at Wedbush Securities, spoke a little bit about this in the future of Tesla. Let's just listen in to what he had to say.
The longer term story here is autonomous, is robotics, is essentially the AI play. Street, what they needed to see here, show me margins. You cannot have margins going toward 13, 14%. Now that margins are starting to level off, that is so important, not just from a cash flow perspective, but showing the worst is in the rearview mirror. And when you think about all the bears and all the negatives, it comes down to deliveries will start to uptick. China, I think, is a source of strength in the quarter. But that gross margin, it's a Goldilocks for any bear. Okay, it's a Goldilocks for any bull. The bears, it's kind of a nightmare for, because that was ultimately the core of the story.
So Daniel, I was talking about the gross margin again. Look, one thing to note about the quarter, though, which we haven't touched upon, is regulatory credits.
Yes.
It's not as exciting as autonomous cars and cybercabs, but it was an extremely important part of the quarter. Now, effectively, regulatory credits are those credits that Tesla can sell to other automakers, and they're effectively, 100% profit because they're just selling these credits off, more or less. And so that's been a huge part of the margin story in this quarter as well, the profitability story in this quarter. Now, when you strip that out and you look at the margin for automotive X, those credits, it's around 17%. So it was climbing higher, but clearly those margins have had a boost from regulatory credits. But that can be a bumpy number as well going forward. It's a business. I mean, Tesla's billions of dollars over the last few years on, as other players haven't really caught up to their sort of requirements around these credits as well. And so that's something that's supported the Tesla business. Question is, think going forward, how long is that going to last as other traditional automakers jump into EVs as well? But clearly it's still big business for Tesla and supporting the profitability side, the margin side of the equation as well.
Okay, huge amount to discuss. I think the point that you make on a regular basis and others make is we can't continue to look at this. Even as a technology automotive company, it is a company that is an AI investor, it is a battery investor, it is energy storage investor. If that's not battery, well, there are derivatives of that. It's about the credits. So when we look at it and we criticize the car sales compared to the lofty expectations from the CEO, we have to realize that there's 4 or 5 other factors going on here, which makes it just that little bit different, which doesn't necessarily mean it's worth 70 times forward, but it certainly gives them a little bit more leeway.
Yeah, absolutely. And then the software side, if this autonomous driving software solutions do come to pass, get the regulatory approval as well, and begin to sell, that becomes a new business, almost like the Apple model of selling services on top of the hardware.
Nice man. Thank you very much, Theo. We'll see you later. Carolyn, here's an interesting thing. I've been bemoaning for days why the bond market and the equity market in the United States are all reacting to political realities and growth realities and debt realities, but the equity market hasn't as of yet. And then all of a sudden, as if by magic, the equity market thought, hang on, this affects us as well.
Absolutely, and that's why we saw broad-based declines in yesterday's trading session. Take a look at the Dow, off by almost 1%, seeing its worst performance in more than a month. But really, the brunt of the selling was borne by the Nasdaq Composite, down by 1.6%. And I do want to show you the tech names that really were a drag on the market. These are some of the names that underperformed in yesterday's trading session. Take a look at this. Meta down 3%, Apple losing a little bit more than 2%. There's an Apple commentary here in terms of reports on weaker iPhone 16 demands. So that's also weighing on the stock here currently. Alphabet off by 1.4%. But obviously, coming back to what you just said here, Steve, if you're looking for a culprit in the sell-off here, well, look no further than Treasury yields. They're close to 3-month highs, and this is what we're seeing here when it comes to the 10-year level. It broke above that 4.2% level earlier this week, currently at 4.22%. Obviously, the market reacting to the inflationary outlook potentially under Trump, but also some of the hawkish commentary that we've seen from Fed officials over the last couple of days. So the market toning down their expectations as to how many cuts we will be seeing from the Fed. And that in turn also has had a huge impact on some of the dollar crosses. I want to show you where the dollar is trading close to a 3-month high. The euro dollar 107.89. Coming up on the show, the IMF warns global public debt will hit $100 trillion this year. We'll bring you more of Kering's interviews from the group's meetings in DC. That's after this short break. Plus, luxury house Kering warns of its lowest full-year profit since 2016 as third-quarter Gucci sales are hit by weak Chinese demand. We will be breaking down the numbers. And Barclays earnings are set to cross the wires at the top of the hour. Don't miss our first on CNBC interview with the CEO. That's at 7:05 London time. We'll be back in 2.
A warm welcome back after the first 15 minutes of the show. Right, Norwegian oil and gas producer Equinor has reported adjusted pre-tax profit of $6.9 billion. That is below some estimates in the market and down on the year. Despite that, the company left its production guidance for the full year unchanged. Let's speak to Anders Opedal, who is the CEO of Equinor. Anders, always good to speak to you. I'm sure we'll learn something in the next couple of minutes or so. Look, you can't do a vast amount about underlying commodity prices, but what you can do, of course, is increase your self-help as well. How difficult is it in the current environment to actually keep production targets on track and keep your growth projections on track as well, sir?
Well, that's all about, drilling. It's about maintenance. It's about making sure that we have safe and efficient operations all the time. And our organization is working really hard. And actually, this quarter, we can announce that we have produced 1 billion barrels from the giant Johan Sverdrup field. And we also set our production record in the quarter. And the Troll field, the gas giant of Norway, actually the last 12 months never produced more than we produced over the last 12 months. Actually supplying Europe with 11% of the gas demand. So by a lot of good work over many, many years, investing in the portfolio on the Norwegian continental shelf, we are able to produce and keep the production guidance as we do today.
And that's great. And I get it. The maintenance, the production, getting these fields pumping as near full tilt as you can. But the problem is that pricing that I just mentioned in my first question, it perhaps clouds the investment case for higher capital spending going forward. My understanding is today you do see lower capital expenditure. Is that just purely a product of price, Anders?
No, that is kind of annual changes. Some spending is postponed to next year. We have reduced a little bit of the spending on the onshore renewables, and it's also a currency effect. And what we are focusing on all the time, even in high commodity prices, low commodity prices, is to ensure that we are able to produce and develop our project with as low break-even as possible, such that we can withstand all these changes in commodity prices. As you said, we cannot do anything with them. So that's what we're focusing on. We have done that for many years now, and you see the results in this quarter with good financial results. We're keeping the guidance on the cash flow from operation after tax, and also the competitive dividend of $14 billion.
And as you mentioned renewables, let me pick you up on that, because obviously you recently bought that 10% stake in Ørsted, one of the biggest wind farms in the world. And we know that Ørsted specifically has been beset by troubles in the U.S., whether it's supply chain issues, cost issues, big write-downs. How much trust do you have in the business, for the operations to turn around? And would you prefer to actually take a stake in a public company rather than developing these projects yourself, which you have also done in the past?
Well, first of all, we are into a kind of an all-time high in terms of our own organic projects in US, in UK, and in Poland. But at the same time, we decided to invest in a counter-cyclic investment in a good company that we know well, in an industry that we know well, and actually get more exposure to a premium portfolio. So we will increase our exposure in renewables and offshore wind in a profitable way, and we see also this as a way to be a long-term industrial owner of a good company like Ørsted.
Let's stay with renewables for a moment here. Obviously, we're 2 weeks away from the U.S. elections. We know that one candidate is intent on rolling back parts of the IRA. How much is some of the production, some of the activity that we're seeing in the U.S., how much is that at risk? How much do you worry about the continued push in terms of the rollout of renewables? Because there's only so much that the one candidate could do in terms of reducing some of the renewables here, given the jobs it has created in red states.
Well, as Equinor, we have a good history of working with administration, both from the Republicans and from the Democrats. And we are investing both in oil and gas and renewables in the US, creating jobs locally. And we will continue to do so. We'll see that maybe there will be some differences in policy, but we still think US is a core country for us, that we will invest both in renewables and oil and gas.
Anders, there are certain governments when they come in who think you can just tax away as aggressively as you like on the dastardly industries, the banks, the oil and gas producers, and there's going to be no ramifications. That's clearly not the case. Historically, that's not the case. What's your words to Rachel Reeves ahead of her October 30th budget?
Well, now we have to see. We had the Labour manifesto, and now on the 30th of October, we will see how this will actually transport into the budget. For us, the key message to all governments is we need stability and we need predictability in terms of the oil and gas taxes, renewable taxes around the world, and that is also true for UK. We have seen that there has been some changes with the previous government and no changes again with the new government. At the same time, we have seen stability and predictability in renewables in terms of UK being kind of a fast mover in terms of renewables, and also now CCS. So it's a picture where we see where we advocate for stability and predictability, and the government has invited in for discussion with the recent investment summit in London, where we had opportunity to communicate our needs.
Anders, thank you so much for your time this morning. Appreciated. Anders Opedal, the CEO of Equinor. Now, let's push on. The IMF says global public debt will hit $100 trillion by the end of this year and reach 100% of GDP by the end of the decade. In its fiscal monitor report, the fund said policy uncertainty and growing spending pressures could push debt levels above current projections, with governments facing public resistance to higher levels of taxation. Now, Karen, she's not here. She's in Washington. She caught up with the IMF's Gita Gopinath in Washington, D.C., of course, and asked her about risks to the growth outlook.
The world economy has certainly shown resilience, some places more than others. The U.S. economy, for instance, is really showing strong growth, and we keep revising our forecast upwards. And inflation has come down almost everywhere without any big hit to economic activity. So I think these are all very good signs. But as you said, there are several risks yet on the horizon. Geopolitical tensions, I would say, are one big one. There is, of course, also the outcome of some very big elections that are going to happen soon around the world, and that has implications for policies, China's growth, the potential direction, whether all the recent measures will raise growth, is to be seen. So we still have the Middle East, and that could turn into a wider conflict, and that could affect oil prices. So there are several risks that we do worry about.
Indeed, I want to get into some of those geopolitical risks, because the latest twist here is that North Korean soldiers are now training on the ground in Russia. The US and NATO allies believe that if these troops were to join the front line, it would mark a significant escalation. How concerned are you then about each twist and turn we are seeing in these geopolitical stories?
Yeah, again, without commenting specifically on the development you mentioned, geopolitical tensions have implications for the world economy. The last time there was the conflict, the Ukraine, when Russia invaded Ukraine, we saw a big increase in energy prices. Food prices shot up, so we had the whole cost of living crisis. And right now we're in a good place with inflation. Inflation is coming down, and we need to do everything we can to prevent pressures on inflation going in the wrong direction. So our ask for all conflicts in the world is to be able to end that soon in a peaceful way.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.